At 8:03 on Friday morning, your salary lands. For 3 seconds, you feel richer than you did yesterday. Then your landlord sends a message. Rent has gone up again. Effective today. You leave for work telling yourself it's annoying, not dangerous. On the corner, breakfast costs more than it did last night. The shopkeeper doesn't apologize. He reaches for the chalk. By lunchtime, he changes the price a second time. That is when the day stops feeling normal. Your money hasn't vanished. The numbers are all still there. They just buy less every time you look away. Your coworker whispers that the currency dropped overnight. Not at the rate shown on television. At the rate people are actually using outside. You open a currency app. The chart looks like it fell off a building. Suddenly, everyone around you remembers the same lesson. A currency only works while people believe tomorrow will resemble today. Once that belief breaks, people stop storing money. They race to turn it into something that might survive. Dollar, gold, fuel, food, anything but the currency. So you leave work early and head to the bank. There are already 40 people outside. Nobody is shouting. That makes it worse. At the door, a guard tapes up a withdrawal limit. Your entire paycheck is inside. But today, the bank decides how much of it feels real. You ask for foreign currency. The teller gives you the smile people use before saying no. Officially, the bank has dollars. Unofficially, they are reserved for somebody more important. Outside, a stranger offers you the same dollars immediately. His price is almost twice the official rate. You can refuse him and keep losing money, or accept his price and admit the official one is fiction. This is the first rule of a collapsing currency. The same money begins living two different lives. One life appears in speeches, bank windows, and television charts. The other decides whether you eat dinner. And this is only day one. Because tomorrow, your boss, your bank, your landlord, and your family will each make a different choice. And every choice will change what happens to you next. Monday morning, your office feels strangely crowded. Everyone arrived early for the same reason. Nobody wants last week's salary sitting untouched. Your coworker has already paid 3 months' rent. Another bought cooking oil by the carton. Someone else ordered a refrigerator they never wanted. They're not shopping because they feel rich. They're escaping money before it shrinks again. You open your budget and hesitate. Yesterday's careful plan already uses yesterday's prices. Your bus fare rises before the ride home. The driver points silently toward the fuel gauge. Your electricity company sends a revised bill. The amount changed after the meter was read. Your mother's medicine costs even more. The pharmacist says the next shipment may not arrive. Suddenly, waiting until payday feels like gambling. Your boss calls everyone into the meeting room. He promises salaries will rise with inflation. For one moment, the room relaxes. Then he says the adjustment begins next month. By next month, today's raise may buy less. Someone asks to be paid every Friday. Someone else asks to be paid in dollars. Your boss has neither enough cash nor dollars. His customers still pay him in local currency. His suppliers now demand payment in advance. The company is trapped beside its workers. So payday moves from monthly to every 2 weeks. 2 weeks later, it moves to every Friday. Each shorter cycle feels like protection, but every payment starts another race. You receive money and leave work immediately. First, you buy the medicine, then rice, cooking oil, and bus credit. You pay rent before the landlord changes it. Whatever remains goes into foreign currency, except the exchange shop has no dollars. A handwritten sign promises more tomorrow. Tomorrow's price is exactly what frightens you. You return home carrying bags instead of savings. Your kitchen shelf has become your bank. Food holds value better than your paycheck. But food cannot pay every future bill. And now the prices themselves begin breaking. Tuesday begins with a supermarket employee holding labels. She changes one price, then changes it again. Customers follow behind her filling their carts. Nobody knows which number will survive until checkout. At the register, your total exceeds the shelf labels. The cashier looks tired of explaining. The store paid more for today's delivery. Tomorrow's delivery has not even been priced. The owner calls his supplier while you wait. The supplier refuses to quote beyond this afternoon. Fuel, packaging, and replacement parts all cost more. Even local bread depends on imported machinery. The bakery's oven needs a four-made component. The broken component now costs 4 months' wages. So the baker keeps the old oven running. He makes smaller loaves to protect the price. Customers accuse him of quietly cheating them. He opens his invoices and shows the truth. Everyone in the room is losing differently. At the pharmacy, imported medicine disappears first. The cheapest substitute vanishes the following week. A handwritten limit allows 1 box per customer. You call 3 pharmacies before finding your mother's pills. The final shop accepts only foreign currency. You offer local cash and receive a calculator. Its exchange rate changed since breakfast. You surrender more money than you expected. Outside, the fuel station has another line. Tankers must purchase oil priced in dollars. Drivers must purchase fuel priced in local money. That gap moves through every road and delivery. A farmer pays more to run his tractor. Fertilizer and seed rise with the exchange rate. His harvest will arrive months from now. His costs arrive today. The restaurant removes meat from 2 meals. Then it replaces printed menus with a chalkboard. A repair shop begins stripping parts from old machines. A delivery company cancels its farthest routes. Every shortage creates another price increase. Every price increase encourages another panic purchase. Shelves empty even when warehouses still hold goods. Owners wait because selling today may guarantee tomorrow's loss. Money is no longer measuring value properly. And when prices stop speaking clearly, banks become louder. Wednesday morning, the bank queue bends around the corner. People are not chasing profit. They're chasing access to their own money. The ATM accepts your card and thinks. It displays a smaller daily limit. You try a second machine. It gives you the same answer. Inside, every chair is occupied. A father needs tuition before the school reprices. A shop owner needs cash to restock. A traveler needs dollars for tomorrow's flight. Each account shows enough money. The bank does not hold every balance in cash. Normally, it never needs to. Depositors leave money while borrowers use it elsewhere. But normal banking depends on people leaving calmly. Today, everybody wants the door at once. The teller repeats the withdrawal limit. You ask whether the limit is temporary. She avoids promising a date. Your transfer to the landlord remains pending. The landlord does not accept pending. He wants cash or foreign currency. You ask the bank to convert your balance. The official exchange rate looks surprisingly generous. The teller says foreign currency is unavailable. Behind her, a private office door opens. A suited customer leaves holding a sealed envelope. He did not stand in your queue. His company earns money abroad. His bank manager knows his name. Crisis turns access into a separate kind of wealth. Outside, street exchangers know this too. They sell speed, secrecy, and certainty. They also sell risk. Counterfeit notes begin circulating beside real ones. Police chase exchangers without removing demand. So the market moves into phones and backrooms. Your cousin offers dollars through a messaging group. You must transfer local money before meeting anyone. You stare at the unfamiliar account number. Losing value slowly is painful. Losing everything to a stranger would be worse. You close the app and keep the local currency. Then you remember the loan waiting at home. Your apartment came with a fixed local currency mortgage. Last year, the payment felt enormous. Today, one supermarket trip nearly matches it. Inflation is quietly shrinking the debt's real weight. For the first time, depreciation appears to help you. Then the bank sends a refinancing notice. Your fixed period ends in 3 months. The new rate follows inflation. Relief turns back into a countdown. Your coworker borrowed in dollars instead. The interest rate once looked cheaper. His salary arrives in local currency. His debt does not. Every depreciation makes the same dollar payment heavier. He sells his car to cover 2 installments. Next month, he may sell something else. Meanwhile, your savings account earns interest. The number grows each month. Prices grow faster. Your bank statement says you gained money. The grocery basket says you lost it. Cash savers absorb the inflation tax first. Owners of scarce assets play a different game. Your landlord owns 3 apartments. Their walls do not multiply overnight. Their rents can. A warehouse owner holds imported spare parts. Every currency drop raises their local price. A gold dealer opens before sunrise. Customers queue for metal they cannot eat. They're buying an exit from the currency. But even assets create new problems. Property taxes, repairs, and security still cost money. Gold needs a trustworthy buyer. Cars need imported fuel and parts. The winner is not simply whoever owns something. It is whoever owns what others suddenly need. A farmer with food gains bargaining power. An exporter with dollar income gains even more. A pensioner holding only local cash loses quietly. A young borrower with fixed local debt may gain temporarily. Same crisis. Opposite balance sheets. The currency does not choose winners by morality. It follows contracts, assets, income, and timing. Businesses discover that rule next. Your company imports the component that keeps production moving. The supplier wants dollars before loading it. Your company earns local currency after delivery. The timing no longer works. Your boss applies for official foreign currency. The application joins a stack of applications. A committee decides which imports are essential. Medicine receives priority. Fuel comes next. Your machine component waits. Without it, one production line stops. Workers from that line are sent home. Your line remains open for now. Nobody celebrates. Across town, an exporter faces the opposite problem. Foreign customers pay the exporter in dollars. Local wages become cheaper in dollar terms. Export profits swell when converted back home. The exporter can afford fuel and imported parts. It can also hire workers your company releases. A weak currency has created a powerful business, but only because that business earns strong money. Smaller shops cannot rearrange themselves so easily. A phone dealer sells the final imported handset. Restocking would require twice yesterday's local cash. He closes before selling himself into a loss. A mechanic begins requesting payment in engine oil. A baker pays one worker with flour. A transport company offers drivers fuel vouchers. Barter returns because both sides distrust the unit. Large companies invent cleaner versions of barter. They index contracts to dollars. They shorten supplier quotes to 24 hours. They add adjustment clauses to every invoice. Lawyers become part of ordinary pricing. Connected companies receive faster approvals. Their shipments clear while competitors wait. Crisis rewards access before efficiency. Rumors of favoritism spread through closed factories. Workers blame owners. Owners blame banks. Banks blame government policy. Government blames speculators and hoarders. Everyone has evidence, and nobody has enough dollars. Wealthy families solved that problem before you noticed it. Months earlier, wealthy families saw reserves falling. Their advisors did not call it panic. They called it risk management. Money moved from local accounts into foreign ones. Companies prepaid overseas suppliers. Families bought property priced in stronger currency. Some purchased gold stored outside the country. Others accelerated plans for second residency. By the time you saw the breakfast price change, they were positioned. Now their foreign dollars buy more local assets. Apartments, businesses, and land suddenly look discounted. Your crisis becomes their shopping season. Not every wealthy person wins. Local factories still lose customers and imported parts. Property can sit empty. Governments can impose taxes and controls. But wealth creates more doors to test. A private banker answers calls after business hours. An international lawyer understands the new restrictions. A second passport turns leaving into a decision. A foreign account keeps working after local limits appear. Your family has different escape routes. A relative abroad sends dollars each month. The remittance now covers more local expenses. But collecting it requires another queue and fee. Your sister sells jewelry to protect the rent. Your neighbor sells his motorcycle to buy food. Each sale solves today by sacrificing tomorrow. Rural relatives grow part of what they eat. Their cash income is smaller. Their exposure to supermarket prices can be smaller too. In the city, every meal passes through a cash register. Transport consumes more of your wage. You begin walking part of the route. Your mother divides medicine to make it last. You remove meat from weekday meals. None of these choices appears on the exchange rate chart. Yet this is where currency collapse becomes physical. It appears in calories, distance, health, and time. Poor households cannot hedge with overseas property. They hedge by consuming less. Middle-class households sell the assets meant to protect them. Wealthy households move the assets themselves. The currency crisis widens every existing exit. Eventually, the government must try closing the fire. The central bank raises interest rates. Saving local money should become more attractive. Borrowing becomes painful immediately. Businesses cancel expansion. Families postpone homes and cars. The government cuts spending to reduce money creation. Public projects stop mid-construction. Subsidies shrink while prices are already rising. Officials tighten access to foreign currency. The street rate moves further from the official one. Police raids may frighten traders. They cannot manufacture missing dollars. Then the government unveils new banknotes. The designs are cleaner and the zeros are fewer. Your old thousand becomes one new unit. The arithmetic becomes easier. Trust is not. A renamed currency cannot erase the old memory. So authorities search for a stronger anchor. They may promise reserves behind every note. They may peg the currency to a stronger one. They may allow foreign currencies to circulate. In extreme cases, they may abandon the currency entirely. Zimbabwe's prices once doubled almost every day. People shifted toward foreign currency and barter. Stabilization arrived only after the old system ended. Lebanon shows another side of the damage. Currency collapse can become a banking and deposit crisis. Fixing it means admitting losses already exist. Somebody must absorb those losses. Depositors, taxpayers, bank owners, or outside lenders. Protecting smaller savers becomes a political choice. Rebuilding reserves is not enough. The public must believe tomorrow's rules will remain. That belief returns much slower than a new banknote. Months later, the breakfast price finally stops changing. The shopkeeper leaves yesterday's chalk number untouched. You notice because stability now feels unusual. Your salary still arrives every Friday. Your employer no longer promises distant adjustments. The bank raises your withdrawal limit. You test it before believing the notice. The ATM actually gives you the cash. Shops continue accepting foreign currency beside local notes. Contracts remain shorter than they once were. Families keep food, fuel, and dollars as backup. Trust returns as a habit, not an announcement. You rebuild savings in several different forms. Some stays in the bank. Some stays in foreign currency. Some becomes food, repairs, and useful assets. You no longer confuse a large number with wealth. You ask what the number can reliably buy. Currency is not merely paper, metal, or an app balance. It is a promise shared by millions of strangers. Employers promise wages will hold value. Shops promise prices will remain understandable. Banks promise balances will remain accessible. Governments promise tomorrow's rules will resemble today's. When those promises fail together, money becomes a race. The wealthy race through doors built years earlier. Everyone else races through shops, queues, and sacrifice. And the real value of money becomes time before it disappears.